Morning. Let me reload on the cafe. We'll go shortly. terrible. They just don't get clean. All right, I guess I won't wear them. You guys ready to go? Nine o'clock in the morning. Stock market's going to open up in 30 minutes. All right, then let's get on with it. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning your trades in advance. Because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money, cannot afford to lose. All right, my name is Wayne. I am here to help. I do these live streams to help. Cool. So awesome. If you look in the description below the video, there's more resources to help. There's a link to tradersway.com, an ethical and trustworthy foreign exchange broker that I recommend. There's a link to investorbootcamp.com, has 88 hours of training videos for $88 a year. There's a link to quantbox.co that automates your macroeconomic research and analysis. There's a link to tradeplans.ai that gives you feedback and a second opinion, technical analysis feedback, and a second opinion on all your trades, totally for free. There's a link to my book. There's a link to free Forex training course. There's a link to a fundamentals training course, how to 3x your profits. Okay, all those links and resources are available to you in the description below. Yeah, cool. Now it's you got to do something. You got to make a change. Got to take a look at yourself and make that change, right? If you're going to make a difference, you got to make a change. My ghee is solid again. All right. All right. So, are you going to buy oil or what? Huh? What are you going to do? Got yourself a little red candle. How low will it go? What are you thinking? Huh? What are you thinking? Up, down, up? Oh, really? Sound just dropped? No. No, it says you can hear me. Yeah, no, it says you can hear me.
Testing, 1, 2, 3.
It's low. I can do that. I can fix that.
Testing, 1, 2, 3.
Yeah, it seems to be the right mic. Okay. Yeah. All right. Yeah, I turned it up. Turned it up, sure enough. All right, so what do you think? Are you going to buy the dip? Where? Kick it off to 21? Kick it off the 8? What do you think? On our way to 95 again? Just a little bit. What about the S&P 500? What do you think? Is that the next 24 hours? What's your plan, Stan? I just spilled coffee all over my keyboard. All right, very nice. Just looking at some data. Commander data. Four, 3, 4, 3, 2. 5, 5, 5, 2, 0. Wait, no disposable income? Adjusted for inflation, negative disposable income. Wow, time to pay down the credit card. Otherwise, you're going to work for your master for years, your MasterCard. Personal consumption expenditures 0.1, 0.6, 0.2, 0.6, 0.8. Wow. Yeah. Little hot, huh? Little hot. 4.3, sorry, 4.2, 4.3, 3.8, 3.0, 3.3. Ooh. Yeah, wowzer, huh? Yeah, well, it's Friday, huh? We made it through all the big noise and all the big news. Looking forward to a good week next year. Next week, I should say, next year. What do you think? Why don't I do a poll? Let's do this. What do you stink? How about this? How will next week trade? Risk on? Risk off? Risk new. Look at the dip. Very, very interesting. 92.5. Let's drop into a Cinco. What are you thinking here, huh? Are you going to do it? All right, we have 17 votes. Everybody else has broken fingers and they can't type. Look how dirty these glasses are. I can't believe I just cleaned them. Emmanuel's like, I can't type, I'm buying oil. Well, Jim's got one good thumb at least. He's right. He's like, my thumb. There's my thumb. All right, 25 votes. I got to have 30. Oh, that's better. Actually, it's not better now. I'm too close to the screen. All right, so anyways, cool, right? Look, there's your 50. There's your 50. 618 just below us. Is that right? Already got it earlier. Yeah. Well, this is that sort of like market open play. Yeah. In the oil trading course, those that have attended live, they got the trading, the scalping part. And I give a particular time of day to be trading U.S. oil. Yeah, and that's probably what you were doing. So there's that. I can change this setup. I don't know if I actually want to change this setup. So why don't I flip over and pull up the same thing somewhere else. I think I have it somewhere else. Commodities, I guess. I'm on commodities. Do I have it anywhere else? Oil? Do I have an oil? Do I have it anywhere else? Maybe under market? Yeah. Oh, good. That's what I wanted to get to anyways, this setup. Okay. And this setup shows probably what Jim was doing right there. Yeah. America. Cool. So I'm going to mark my territory. Okay. Market open 303. Okay. Oh, is that right? On the 4H? Yeah. Yep. Yeah, so we'll see. It's kind of interesting, right? Of course, it's informative if it collapses, because then you have the reverse fib going on. Okay, we have 30 votes. You can also take a look Fibonacci-wise. Yeah, and that bottom was a 382. Yeah. Cool. Take a look at gold hitting target. Okay. Gold hitting target like a band of shoplifters. Next target is 18. Okay, the gray zone is the expected take profit. It's the expected lowest low of the month of September. So we hit it and there is profit taking. Yeah, cool. Commodities seem to be doing their thing. Euro buck. Okay, Euro buck maybe, right? If we're going to use price action. Well, I guess I have to do more price action, right? Double bottom. Okay, so here's the first bull. Up, 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 down, down, buy. Okay, up, 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 down, down, buy. Off the rolled reversal. Do a new up, 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 up. What do you stink? Smell like a plan? Topped out. Sure would be nice if it turned long-term bearish. So wouldn't this be interesting, huh? Technically, that's a lot of hope, but that is what I'm hoping for. There's that S&P. Come on, S&P. Let's go to the 200. I increased my position by 12% yesterday. No, these are not good. So that would be really nice if I were me. Okay. Oh, oh, ooh, ooh, ee, ooh, Okay, let's try it. I'm just tightening this up. Wait for it. Let's kind of zoom out a little bit. Let's look at a daily candle. Let's do that for a sec. Okay. It's got to stay above that, don't you think? I'll do real body, and then I will do wick. So we got to stay on this bottom one, right? So let's go 5. Yeah, that's the bottom of that range. Hang on, 303. Hang on. Something popped up in the way. You had a question. Okay. Surely higher for longer trumps risk on FUCOR. No. Why would it change that? Seasonality trumps the Fed. Look, what we've already priced in one more rate hike. So what's the big concern, 303? So once people adjust their portfolios, they're going to trade normality. But higher for longer doesn't mean down. Higher and higher and higher means down. So if we're at or incredibly close, see, like if we've priced in one more rate hike, then it's done. Then we're at peak. And that's kind of what I think is being traded 303. Okay? So there's this idea of not any higher than our current prices, not any higher than the next price. Then we've hit a top or a bottom, depending on the direction. Okay, just one more can produce a relief rally. I think other things would create dramatic risk off, but not another rate hike that's already anticipated. How do we know there's one more rate hike? Yeah, absolutely. Yeah, that's right, Jim. The Fed told us. Yeah, 303 Acidity says, yeah, the bond market certainly spoke to us. Correct. So wouldn't it be cool if the stock market went up and the bond market continued to fall? I think the bond market will continue to fall until we know for certain, like the Fed raises and then pauses again, and then it gets priced into the bond market. Remember, the bonds trade based on math. Does anyone want to do the math for me? I haven't even sent out an email yet. I started the stock trading course, so I apologize if I started without you. I announced it at the Q4 Outlook, and then after the Q4 Outlook, we did the first lesson, which was an hour and 45 minutes long. And I did some valuation models, amongst other things. Okay? And one of the things we looked at is bonds as well as other things, but we looked at if you gave up $1,000 today, right? And you were going to be paid $1,000 back in 1 year. So you buy a 1-year treasury. How much should you pay for it today? You want to look at things like, well, do you expect the Fed to stop at 5.5? Do you think the Fed's going to go to 5.75? Do you think the Fed is going to go to 6.0? Well, what you think will determine, okay, how much you're willing to pay. Your expected return, your expected interest rate, your opportunity cost. All these things matter. So you can do the calculation. Okay, the present value of the $1,000 cash flow 1 year from now is equal to 1,000, right, over 1 plus I to the n. N is 1 year, so you don't need this, and therefore you don't need the brackets. Okay. I is what you expect the interest rate to be, let's say. Your opportunity cost, because you could just buy a treasury and get that. So anyways, you could do the math, and depending on what you put as your I, you get an idea like the present value of that $1,000 1 year from now might be worth $952. So what happens is you go into the bond market and you pay $952 today, so you have cash flow 0, okay? And then 1 year from now, you get cash flow 1, which is $1,000. So you invest $952, and 1 year from now, you get $1,000. And from that, obviously, you've done some sort of calculation of what you think interest rates will be in the future. Okay? Now, for those in the bond market that think the Fed might go 2 or 3 more times, their I is different. So if your I is 5.5, it'll be a higher number. If it's 5.75, like this is probably about that, then 952. If your number is 6.0, then what you're willing to pay for a bond that pays you $1,000 1 year from now, you're like, well, over the course of the year, you believe interest rates are going to go to 6%. 2 more hikes. then that bond is worth $934 to you or something like that. And you can see as interest rate expectations go up, the value of this bond goes down. Okay, you see? But at some point, I will stabilize. So we'll do an I bar, meaning it'll stabilize and nobody will have lower future expectations for the bond market. The bond market will stabilize. And then bond traders might say, wow, the 10-year T-note is paying 5.1%. I could buy that and just hold it, which is another way of saying the yield is enough to compensate you for your risk and probably higher than future inflation. Maybe not in 1 year, but in 10 years. So at 10-year, you might say, dude, if I earn 5.1% on a 10-year T-note for 10 years, and inflation drops to 2%, you're earning double the level of inflation. So you're buying, so let's say you end up buying, right, at a much lower price. Basically, you're picking the bottom on the 10-year T-note, and you hold it to maturity, which would be 10 years. And you get 5.1, 5.1, 5.1, 5.1, 5.1, 5.1, 5.1, 5.1, 5.1, and then 5.1 plus your $1,000 back. And that's higher than a 50% return, by the way, because you're like, well, isn't it 5.1 times 10? Well, I guess it is, because it doesn't compound, right? So yeah, so you make a 50%. Yeah, so you get 1,500 and a little bit more than that. And you're like, dude, good deal. Wait, no, yeah, that'd be right, yeah. Now, Acidity, you say two things. You believe in the seasonality, year, and Santa Claus rally. Those are two different things. There's seasonality and there's the year-end rally. The year-end rally is in like the last 2 or 3 weeks, right before Christmas. This is way bigger than that. And you want to believe, but what do you mean want to believe? I suppose you can say, well, Santa Claus came to my house every year for the first 20 years of my life, and after that, Santa Claus kept coming. Okay, so all I know is there's a high probability. Yeah, well, Q4 risk on is different than a Santa Claus rally. I need to make that distinction. Those are two different things. The Fed is waving a red flag and the bond market yields. Okay, I get you. So all I can tell you is what I'm setting up on the short run for the medium run. So I'm not predicting the future, but I am incorporating the past. But the way I see things is that we're at the end of a cycle, and most people, if not everybody, knows it. So there might be a bigger issue with the bond market. I think there's actually newer issues. Like, for example, the stock market fell hard in the third quarter, which is normal. But at the same time, the bond market was falling and is exponentially falling. Okay? Oh, well, they're supposed to be non-correlated. If the stock market's falling, bonds should be rising. If bonds are falling, the stock market should be rising. So anyways, I think there's something newer going on here. And the bond market fall, 303 acidity, isn't a sign necessarily of the economy. But we do know somebody is selling treasuries, or at least not buying them. And I think two issues, maybe it's not everything, but two big issues, is that the Fed already has sold $1 trillion of treasuries. Let me say that again, 303. The Fed recently has sold $1 trillion of treasuries. See, they had them on the balance sheet. They bought them up during quantitative easing. Now they're selling them, and that's why you see yield on 10, 20, and 30 going up. On top of that, you have the federal government, the Treasury, issuing new treasuries, which is also selling. So like the supply of treasuries is going up through the roof. And when the Fed is offering for sale all their treasuries, not all of them, but they have 4 trillion more to go. Okay? So there's this huge supply of treasuries coming from the Fed. They're used treasuries. They're called seasoned. Okay? There's fresh cut and then there's seasoned. There's fresh cut, slightly seasoned, and seasoned. So the Fed is dumping their seasoned treasuries, and the supply of treasuries has gone up, therefore the price falls. Meanwhile, the Treasury is issuing fresh cut, but nonetheless, they're available as a choice in the open market. So now the market's looking at fresh cut, they're looking at seasoned, right? They're adjusting their duration risk. So like if the Fed raises interest rates one more time, we've already priced that in, and then they move sideways for a long period of time, then the duration risk changes. So if that's the highest interest rates are going to be, let's say in the next 10 years, let's just say in the next 10 years, the Fed reduces interest rates. So this 5.5, 5.75, okay? Like we never go above 6 over the next 10 years. Then at some point, these yields are very attractive and the price of bonds are probably at a 10-year low. Okay, you see? And so does any of this have to do with seasonality? No, but we are at or near the end of the Fed cycle. So a long pause is not an increase. Okay? Now, if the Fed came out and said core PCE has been going up and up and up, so let's say in December, when's the next one? December, and then there's one in March, right? Or is it February? Maybe it's February, December. So there's one in March and the one in February, something like that, right? Let's say in one of those meetings, we find that inflation is persistent, core PCE is going higher, and the Fed now changes dot plots to reflect interest rates probably going to 6.25, 6.5. Oh my God, that's not priced in. And that's where you'd probably get that risk off scenario again, 303, okay? So I don't know if I'm right. I'm just explaining my thought process and point of view. You might be totally right that I think your argument is there's still rate hikes on the table, so therefore the market comes down. And that, right? It is March. Oh, January 31st. That's really soon after December, it seems, huh? But I guess that makes sense. Are we going to Miami for the 31st? I'll have to plan that out. So, right? So the expected return of a stock is equal to the risk-free rate of return plus the beta times the expected return of the market minus your opportunity cost, which is the risk-free rate of return. So that's what 303 acidity is saying. He says because, or she, I don't know 303, or they, could be they think this might continue to go up over time. That the Fed isn't done, that the dot plot is wrong, that the Fed might continue going higher. Therefore, the risk-free and opportunity, risk-free rate of return and opportunity costs are likely to rise, and therefore the stock market has more room to fall. I'm basing my analysis on this, that the Fed has told us they're done after one more hike. So I have this RF bar. So I've fixed it. Or you can do RF star if you prefer. I like bar. So anyways, RF bar would say that the bond market will continue to fall and then stabilize, and not fall is kind of the beginning of possibly back up. Okay? So that's kind of where I'm going to, 303, acidity. So yes, why? That's why. And I get that data from the summary of economic projections. Oh, is that right? Summary of economic projections. Come on, that's the wrong one. June. Come on. Hang on, I'm trying. Maybe I can do this. Fine. It's not letting me. Hang on. I'm messing around with the Fed database. Hang on. Why won't it let me do it? Stupid Fed database, stupid poopy diapers. Huh. All right, it's not letting me, so let's do... let's see, I'm gonna, instead of doing the dot plots, I want to get something different for you. So hang on. It's still doing that. Hang on, this is what I'm trying to show you here. That's not it, and it won't let me go backwards. Let's see if it'll let me do that. 2010. Let's go back to 2010. No, but see, it won't. No, see? And so what I was doing is changing this. 2018 won't do it. Five-year, 10-year, max, won't let me. Well, you can see what they're saying here. I guess, is this good enough? 2023, 5.5. And 2024, 5. 2025, 4. 2026, 3. Okay. Maybe 303. I'm just looking at what we know to be facts. That interest rates will peak around this 5 3/4, right? 5.5. But things might change. Yeah, well, Kashkari is one of 19 people. And he's more, quote unquote, I don't know, if I say radical, you're going to think liberal, but he's one of the outliers. Some people want to jack up interest rates, some want to cut interest rates. But yeah, okay, that's fine. But there are 19 voting members. So let me get that. Well, how about this? I know it from memory. 12 of the 19, 303, 12 of the 19 members want to raise interest rates one more time. Okay? And 7 want to keep them the same. Then in the future, 1 out of 19 wants to raise a second time. 1 out of 19. 18 say, no way, Jose. So now if you think interest rates are going to go higher than 1 more, you're betting on a very low probability. Now you might say, well, Wayne, they're going to change their minds. And on December 13th, we will see it in the summary of economic projections. Well, I'll see it then. Okay? So they also say, just so you know, 303, they want to keep the optionality. So no one will say they're actually done. They shouldn't, because then they paint themselves in a corner. So Kashkari says he doesn't rule out further hikes, but then when we look at how they complete the survey, they tell us what they think. And so Kashkari probably voted as one of the 12 that say hike. But then they ask, okay, if you hike at the next meeting, then what about the meeting after that? And then he said no. So that's what they're thinking now. And that's all I have. After that, it's guesswork and guessing and betting. I'll bet you anything it's wrong. Well, look, I don't trade and invest that way. I only know what I know. Okay, the market's been open 20 minutes. That's cool. I like watching this one. I wanted to watch this one as well. I'm going to switch this to Confluence. My buying price is somewhere around just above 43. Now go out to a hive time frame. What are the big boys looking at? Okay, there shouldn't be any serious resistance for a bit. So I would stink up to 44 and then down. So today would be down to 43 and buy it, and then 43 to 44, and then there would be a real challenge. Yeah, that's, so I'm thinking like in the next 2 trading sessions, you get a down and an up and then a question mark. And by the way, 303, thank you for sharing your opinion and having a conversation with me. I really appreciate that. And again, I'm not saying you're wrong. I'm only explaining how I got to where, I got to where I am. So. Yeah. Well, see, I don't think that way, so I don't have any nuances or ambiguities. I said 2 weeks ago I was going to buy the S&P 500 between 43 and 42. A week ago I said I was going to buy the S&P 500 between 43 and 42. 2 days ago, the S&P 500 was between 43 and 42. I bought it. Yep. So the frustration is maybe either listening to the other people or, the way I think, how about this? Because you never know if you're right or wrong. You can't be so arrogant. Like, I'm not so arrogant where I say, I know I'm right, okay? But I know what I intend to do. Okay? So I've already made all of those decisions. So that's called strategy. I wake up in the morning and I know what I intend to do. I don't know if I'll get the right price. I don't know if I'll be there at the right time, but I know precisely what I want to do and why I want to do it. I just don't know if I'm right. So that's why I use technical analysis. I know the market conditions may not be favorable, so then I don't deploy my capital. But if the technical analysis looks good and the market conditions are favorable for me to employ my strategy, then I do it. So like, for example, the stock market coming down like this makes sense. I also bought the 3rd week of August. That made sense to me because that's normal. That is normal and predictable. And then having to come back around is also normal and predictable. And I know I want to buy around here. I knew that weeks ago. Okay, great. Do I know if it's going to go up? No, I never said that. Subtleties, yes. So I don't know if it's going to go up, but I know I've done my research and I know why I want to buy there. And the reason I picked those price points is this whole gray area says that's the predicted bottom for the month, and this is the predicted bottom of the week. So inside this candle, I bought the S&P 500. I don't know if I'm right, but I knew exactly what I intended to do and why I wanted to do it. Now it's hodl. You guys know hodl? You guys are, if you're a crypto, hold on for dear life. Okay? Do you know what my target is? Does anybody? What's my target for this, for the S&P 500? Denise says, great answer. Wrong. I'll accept it though. No. Think CIA. Don't think FX, think CIA. December, no. But good adjustment. I like that one, Jim. Ashish got it. The year 2050. Eddie got it. Yes. That is correct. Oh, snap. Shut the back door. Yeah, 2050. So now I wait, and when this market turns, or if this market turns technically bullish, I will buy more. Okay? When, going back to 303 Acidity's comments, when I believe the Fed is done, like they've told us they're done, not just SEP, but like when we know they're done, and I see a change in the bond market, I will probably deploy capital into the bond market and do the stinkiest trade an investor can make. Do you guys know the stinkiest trade? It's a trade that stinks. It's a stinky trade. I'm going to pick the bottom in the bond market. And picking bottoms is a strategy that always stinks. Yeah. So I will buy the bottom of the stock market, and I'm going to hold those, and I'm going to be exposed probably the 20-year note. And I'm going to hold it like cash. That's going to probably pay me about 5%. And then I'm going, because it's cash, remember it's very liquid. A 20-year government treasury is risk-free. And I will earn about 5% risk-free for 20 years. But that's not good enough for me. So then I will then use it as collateral to sell options against my position, so that I can have an effective yield of not 5%, but probably 8 or 9%. And that's just wicked smart. Wicked smart. Huh? Yeah, pretty fly for a white guy. A big fella's like, yeah, we're all going to be dead in 5 years. Plausibly. Yeah. Big fella, that's why we're We're 1 minute from hell. Golly, gee whiz, Batman. Yeah, boy. It's a beautiful day. So I'm going to work on the stock trading course. We are going to do, I think I want to do more valuation, continue on the valuation model exercises. I don't want a 2-hour lecture. I apologize for that. 90 minutes is tolerable. They should be closer to an hour. I went like an hour and 45. I just put too much information into the first one. The next one maybe will be like 45 minutes of maybe doing some new valuation models and then maybe expanding a little bit more on the financial market, intermediaries. And then I'd like to work into, because I got to get there, so might as well get there soon. I want to talk about variance, standard deviation, and beta. That's why I want to do some of these models, right? Cool. So I have 1, 2, 3, 4, 5, 6, 7, 8 positions in the markets today, and all 8 are profitable. Dude, so I reduced my position when yields started skyrocketing. I heavily reduced my exposure to the bond market, heavily reduced. My bond, by 99%, right? But it's up almost 1% today. So those yields are possibly turning. Like, dude, this might be, I'm reading a lot into these tea leaves. And of course, I'm reading it with a heavy bias, confirmation bias. But my best performing asset right now is the bond market, followed by NASDAQ. I'm up 0.79% on the NASI. Yeah. Dude, it's a beautiful day. So bonds are up and stocks are up. So anyways, whatever. It's only money. Cool. Well, I gotta go, babe. That was real. Thank you for being here. It's a Friday. The markets are up. Okay. Could be worse. I fully expect pullbacks. Don't get me wrong. I'm enthusiastic for the future, but today doesn't have to remain great. But hope is nice. Okay? So peace on earth. May the pips be with you. May your profits be above average. Take care of yourself here. And I will, if you're in my day trading group, I'll see you Sunday. And I'm sorry, I don't even have a link to give you to sign up for the stock trading course. I'll try to get some time together and put that together for you so you can join the stock trading course. Many of you, dozens of you have asked me to do it. Well, it's already started. It's already happened. So I'll see if I can get to it today and maybe email you a link so you can at least do the first 2 hours over the weekend. And then on Wednesday, we'll do the next one, which means I will work all weekend so that on Wednesday, I can deliver you value. Cool.